All right, stock market analysis. We're going to look at the UK market. Last week we looked at the stocks 50. That's the top weighted stocks in Europe, 11 different countries. I want to focus on the EWU today because there's so much discussion about the real problems that the EU is in and that the UK is in regarding energy issues and massive inflation there and the need to really raise interest rates. And that has these markets in a lot of trouble. China, it is in its own trouble. And I want to show you the financials, which are so important to our markets here in the U.S. And they often provide leadership or show distinct lack of leadership, or maybe leading on the downside, which I'm going to show you. And I'll take a little peek at the S&P 500 short term also, and I think you're going to find that really exceptionally interesting. So let's switch over now to the chart as we look at EWU. Now, if you didn't take that little lesson that we showed, that Katie showed you earlier in the show about cycle analysis, you should go back and watch that. She just did a fantastic job. And you will see that the analysis pretty much is carried across all of the work that we do in this style in this method that we have. Now, the bottom on here is cycle brackets. They're just a drawing tool. And what we're comparing in here are the energetic or money flow movements of the FEZ to the UK. So we're looking at a weekly chart here in the UK. And when you have these upward cycles, in other words, they configure in a way that the highs are lower and the lows are, the highs are higher and the lows are higher, those are what we call bullish configurations. And in this case, the market was moving up very strongly, and that's over in 2020, 2021. You'll note in here that what happened was it made a new high, which was expected, but then this break in here made a lower low, and that gives you this negative configuration right here. Then what happened was there was a significant break in the market. So I'm just going to grab a line in here. This is where that cycle low was. And when it goes underneath that cycle low, it proves to you that it's configuring negative again. And then there's a lot of time left. So you can see in here there was a minor cycle and a dominant cycle. And when they get into these final stages is when you get the biggest selling. You could see that here and here and here. And that's coming right in here. This was a sell zone that was set up based on the magnitude of decline in here. And you could see it just got perfectly into the sell zone and then turned down again. So you have a very weak condition in here, and the likelihood that the European market is going to break below this low, the UK market, get below here at 2788, maybe get down to this area at 2680, which are fib extensions down there. This says that the market is going to be weak into October, potentially into November, between these two lines right over here. So this is an example of a European market that is in a lot of trouble. And based on our analysis, the odds of going down are much higher than the odds of going up. Let's take a look here as we switch over and look at FXI, which is the Chinese market. And you can see in here a very similar condition. Now, these yellow ovals that we're looking at are periods of risk. That is where these cycles are in their final stages. And you can see you get these sell-offs in each one of them. And now we're coming right into here. This is into October and November. The likelihood is high of getting under this level, 2613, potentially getting down here to 2440, which is where we have that projected right now. And again, October, November, there is a lot of weakness projected in there. So you could see these world markets that are significant, they are really in a very, very bad shape. And it is likely that those are going to lead the U.S. markets to the downside. Now, one comment I made before was how important the financials are to the U.S. market, and I want to switch over here and look at XLF. Now, again, what we're looking at are these configurations in here. You had a very bullish condition that was driving this up in this bullish configuration. It said that the next cycle should make a new high, and it did. You can see that. And it said the next cycle should make a new high, and it did. You can see that. But then look here, it broke that, and it had all of this time to fall. Just absolutely mind-boggling how perfect that was. Then when the market rallied, you would expect it to rally into the resistance and fail, and that's what's going on right now. While there may be a little bit of room in here to continue to try to bounce up, it really looks like there's a lot of risk in here, and this cycle trough goes out to March of 23. There's actually a minor cycle right in there that goes out into October, November, which really aligns with what we're looking at in these other markets. So you could get a breakdown in here into October, November, another attempted rally, and then a decline out into March of 23. And we've talked about the likelihood that this bear market goes out into 2023. And when you look at the XLF, that aligns with that. Now, one more thing I want to show you in the XLF, and that's this chart right over here. The top is the XLF chart looking at a daily chart, and the bottom is the relative strength of XLF, and that's compared to the S&P 500. Now, when the market's going up, it's usually led by good relative strength in the XLF, and that drives the market up because the financials look good. But now we're in a period of inverted yield curve, which is likely to get worse, and you can see in here as the relative strength of the financials continues to be in this significant downtrend, and that says to me that the financials are going to lead the stock market to the downside more. And so that very, very key group, which often gives you a good tell on the condition of the market, is now in a period of extended negative relative strength. And that which makes that happen, which are yield curves that where they have to borrow short at higher prices and lend long at lower prices, that puts them in a condition of very difficult to make money. So the financials are in trouble, and that really says the stock market is in trouble. So now let's leave the XLF and go to the S&P 500, SPX. And we'll see in here that what we have looked at was the probability that there would be a failure in these resistance areas right over here, even though it rallied over 17% and then have a decline. Now, because of the length and magnitude of this rally, we have an alternative in here where it may only pull back down to just under 4,000. This support down over here is about 3,900, and it looks to me like that might be the area where it stalls, and then you get another rally in here, and then that big decline that we're looking at out to March, April. So the bear market would just simply continue. In that case, you'd probably get another rally over here that would hook the bulls again, and then move down again. This is the scenario that we looked at that said that there would be a likely resumption to the downside. So again, that resumption looks like it will decline out into late September to sometime in October, and it could simply be just another 120 points to the downside in S&P. It seems like that's not very much. I think it would be more than that as you look at the potentials for some of these lower prices. So best case I'm going to make is around 3,980, maybe 3,900. And then you can see that red line coming down right over there. That was the original very negative projection taking out this low. I'm not sure about that anymore, but I am very positive about this risky area that we're in right now, this yellow zone you can see in here, period of risk September, October, taking it down over here. So we'll just have to see the magnitude of that decline, and it can be very sharp. Now, I want to show you the short-term analysis we shared with our membership this week, and that is that the signs were that because this low was taken out in the NASDAQ and just tested here in the S&P 500, that it would rally up into the minor resistances and then sell off. Well, that was spot on. It was perfect where you got this. And the short-term analysis now points to another maybe 5-6 days on the downside. Here's that area right there, that support of around 39.80. I wouldn't be surprised if it got there. Probably another attempt of a bounce in here. And then this is a big period of risk where they could really throw them away. And you got to be real careful in this period in here of September, mid-September to late September, early October. There is a lot of risk during that time period. So that's a look at the daily. This is a look at the weekly, all in periods of risk right now. And as I said, the world markets, as I showed you in the EU and the FXI, they're in very bad shape. The XLF showing a negative influence on our market overall, and these conditions are bad. And the likelihood of a rally that holds is quite small. The likelihood of large sell-offs like you see here today, with right now, as I'm speaking, the S&P 500 down over 90 points, well, I think there's more of that ahead. That is our view of the stock market, 1 to 3 month view plus a little short-term peek at the S&P 500.